As usual, just going to start off with our disclaimer that trading involves the risk of loss of capital and it's not suitable for everyone. And I'm sure this is boring by now, but as I always say, I hope it is good for you. Many companies provide leverage, so just be aware you can lose substantially more than that initial investment that you make. Views, opinions, everything contained in this is purely for educational purposes, and it should not be considered advice. We're not trying to encourage you to trade or invest. That has to be your decision. And of course, you should carefully consider the risks, your financial situation, definitely your level of experience and risk appetite. And of course, you should only risk capital you're prepared, but most importantly, that you can afford to lose. Any doubts whatsoever, seek independent financial advice before risking your capital. Okay, so we're moving on to what happened last week. The FOMC minutes confirmed that the Fed is determined to beat inflation, although they are struggling because inflation data was stronger than expected, well, by most. CPI core to be expected had increased to 6.6, which was a beat because even though it was 6.4 before, people only expected it to come in 6.5, but 6.6, there it is, which again is just challenging, and it really does put the pressure on the Fed. Also, Michigan sentiment increased, and that was up to 59.8. So again, all of that is really positive data for the US. Jobless claims are slowly increasing, but let's not sort of put much emphasis on that because the job market is still really strong in the US. It's dropped down from its two jobs for every one person unemployed to about 1.65. And of course, when we see next month's data, that'll probably change again. Well, the UK, what can I say? I'm based in the UK. So, okay, first of all, unemployment hit record low of 3.5. Again, that worker demand is there. But GDP, negative. First quarter. So, if we get another one of them, we are technically in that recession. And of course, the UK is nowhere near as strong a economy as the US. Industrial production was also lower. So, again, manufacturing's down. So, we just got to keep an eye on them. But, we're definitely, you can't compare any country, I don't think, at the moment. They're just a powerhouse all on their own. Of course, that will come to an end at some stage. But right, so let's carry on looking at the highlights from last week. So politics again. So the PM sacked her chancellor after about 5 weeks, I think it was. Her job seems to be in danger too, as there's the potential for the Tory backstabbing to continue. That Boris was pushed out. Theresa May had to resign. What's wrong with the Tories? Why can't they actually get behind a leader? Why are they always trying to sort of push them out to sort of for their own gains, I reckon? But all they're doing is destroying the Tory party. So, when there is a next general election and, if they decide to get rid of Truss and bring in a new one, then I'm sure everybody is going to be screaming that they want a general election and that the Tories shouldn't carry on when they're on probably their 4th new Prime Minister since the last election, or 3rd anyway. So with that in mind, it's just crazy what's been going on. So obviously you may have heard that she sacked her chancellor, and I'm not sure what's going to happen. Is she going to survive? She's U-turned on, obviously, Chancellor. She's U-turning on the tax cuts that she was going to give. She's brought in a new Chancellor. We're going to just have to wait and see. But it does bring up some interesting data for this week coming. So In the markets themselves, I mean, we saw on Thursday one of those most incredible rallies in markets history. We'd seen some good, strong data, which is effectively negative for markets at the moment. But it just seemed, what caused that rally, and there's speculation over what that was, whether that was sort of maybe the Treasury, maybe the government, maybe the FOMC, who got involved in that, because it was a very strange, aggressive move. But to be honest, Friday brought everything back down to earth. Everything came back off again. So, it was a very short rally, shall we say. And of course, the IMF has cut growth forecasts again. China, CPA 2.8% and PPI 0.9% year on year. When you look at that, most central banks, they would do deals, probably anything to get those types of numbers at the moment. But it's just not happening. And of course, there's the Chinese Party Congress going on at the moment, which is about re-electing and all the various things that they're sort of looking as to outline for going forward as well. Now, the stocks, when they dropped, one of them, the S&P, I think it was the S&P, I'll check that, that'll come up in the other data anyway, come down to sort of almost touch that 50 level. A lot of the others are sort of through different levels, but just keep an eye on the Fibonacci's on a lot of these, markets, because when they retrace, then that does give you that opportunity to sort of confirm that it is a retracement, and that 0.618 level, which is the golden ratio, is a major level. And it's one to really sort of, I'm very keen on that. I look at it because, if it starts to break that and close below that and continue below that, then in my mind, it goes from being a retracement to being a reversal. On top of that, we had a mixed week for the dollar, really. It's still so strong, and what's going to knock it? I can't see anything at the moment, personally. Oil rallied up to $93 last week before dropping back to 85. Really, probably on again this continued expectations for recession, but even OPEC plus forecast lower demand. And gold managed to rally back above 1700 only to fall again, and it closed the week around about 1650. So if we have a look at what's going on this week, then first thing is there's going to be more earnings coming out. So just keep an eye on them. Again, it's going to be pretty mixed, I reckon, depending on what sectors the companies are reporting from. In the US, we've got capacity utilization, industrial production, some housing data, Philly Fed manufacturing, and the Fed Beige Book. Now, I like the Fed Beige Book, and the reason I like that is because the central bankers, it's more sort of their opinions rather than just data crunching. They're not just looking at data going, this is what I think is going to happen, this is what I expect to happen. It's a little bit more personal than that for them. It's a little bit more about them, and each member from their own region contributes to the Beige Book. So it's definitely worth a look at. It comes out late in one of the evenings. But again, all of this sort of information you can readily get once it's been published just by going onto the central bank websites. It's all there for us. It's part of all this transparency that they give to us. Whether it's a good thing or a bad thing sometimes. It's probably good for us. Maybe sometimes it's not so good for them. In the UK, now there's a gilt auction. Now, I wouldn't normally mention these or public sector borrowing to that sort of degree, but got to start keeping an eye on, if you're trading anything related to the UK, whether it's FTSE or cable, anything related to the UK, then be aware of this. We're much more sensitive to what's going on at the moment. So the gilt auction, because obviously the Bank of England went from a seller of gilts to a buyer of gilts, just to try and stabilise things for the pension funds. We're also going to see inflationary data coming out, CPI, PPI. We've also got retail sales, which is going to give us a little bit more insight into public spending. And of course, that public sector borrowing. Then on top of that, we've got the potential for more turmoil because the PM's reverse policies. Now, there's a big question coming up. Will the Tories unite behind her, or are they going to stab her in the back as well? Hopefully not, because, the UK just can't keep going through this. You can't get rid of a prime minister just because they make a mistake. Otherwise, we'd be getting a new one every week. And that's probably a fact for most countries. So you've got to give her some time to sort of settle in and find herself, and then turn things around. Then, if that doesn't work, then, it probably really is time for a general election and see what happens there. In the EU, we've got ZEW coming out, so that's just sentiment. Again, keep an eye on that. Housing and construction data. And then in China, GDP, industrial production, retail sales, housing, which is a key one at the moment because there's been a lot going on in China about the house markets, etc., property markets in general. And we've got the PBOC rate decision. In Canada, we've got CPI and industrial production. So the macro outlook just continues. Geopolitics is driving a lot of it at the moment in one way or another. The situation continues to impact the markets. I mean, North Korea even fired more missiles. For me, that's just a little bit of attention seeking, but whether that's true or not, I don't know. Russia-Ukraine enters the 8th month now. It's amazing, isn't it? It's been going on for so long. Ukraine continues to regain some ground, but Russia started to bomb some of the major cities in retaliation because the bridge in Crimea was attacked. Now, UK government, again, I've got to come back to that, just remains in turmoil as our new Prime Minister sacked a Chancellor. The guy had only been in the job for 5 or 6 weeks. How much independence each of these get, I don't know. I'm not really into politics. And his replacement actually was was a supporter of a challenger in the race to become PM. So that's going to be interesting to see. But as I keep saying, it's really now time for the Tories to unite behind a PM instead of keep backstabbing them. Otherwise, the public are going to be crying out for a general election. And that really, to be honest with you, could put the Tories out of power for maybe even 2 elections. Central banks. So central banks, there's meetings approaching. We're going to see more rate increases. They're just going to continue. And remember, these higher rates are going to remain with us through 2023 as far as I'm concerned. Now, on Tuesday, I am holding a webinar, and that's based on why central banks are driving economies into recession. I've added the link in there, and it's going to be worth a look at, especially if you're not that sort of knowledgeable when it comes to macro. So I'm happy to try and help where I can. So listen in. Otherwise, just reach out to me and ask me any questions that you may have. Inflation, stagflation, still with us. Inflation is so sticky at the moment. It's really not coming down as the central banks hoped it would. of course, you know, they can only control the demand side, and they're not even getting control of that yet, especially in the US, because, you know, there's just still so much money floating around in the system. And of course, you know, household wealth is still higher than it was pre-COVID. Last time I looked, it was about $144 trillion. That was a few months ago, so it may have changed slightly with the stocks coming off. And, you know, all I can see is that for me, the raw material costs are lower. And therefore, you know, companies should be passing that on to the consumer. However, you know, they've got higher labour costs, higher power costs, and the rest of it at the moment, I would say, is greed. They're holding on to that. You know, they've got the best profit margins that they've had for decades. They're over 15%. And until they start to sort of give some of that savings to the consumer, you can't expect inflation to drop. And of course, you know, as I said earlier, US CPI core was 6.6%. You know, we always look at the core because it's the more stable of the data, because it takes out energy, it takes out food, it takes out alcohol and tobacco. I wonder if that includes e-cigarettes these days. Okay, right, let's be serious again. So recession, I just cannot see any other outcome. It's just a question of how deep it's going to be. You know, I expect probably the US to be the last in recession, proper recession, a real recession. I'm not talking about a technical one because they're already there. And probably be the first out. You know, that's just the way they are. They're such a strong nation. And you know, emphasis on a real recession because, you know, it's so easy to hit a technical recession. What is it? All it is two negative quarters of GDP, consecutive quarters. That is a recession, but does it really mean that, you know, everything's sort of hitting the worst case scenario? I would say not. However, you know, you start to see unemployment rise, you know, job offers disappear, and etc., etc. Then, you know, that's the signs of a recession. And going forward, to be honest, you know, I can't see any other way out of this inflation situation. Again, you know, that's why I'm doing this webinar on Tuesday, because I see that as the only solution that central banks have got. Drive the economy into the ground, and then they can rebuild it once they see that inflation has come down. Now, again, when I say that, you know, that doesn't mean that if they start to see, you know, jobs cut, etc., they're not going to dive in quickly to rescue the economy. They're going to want 3 to 6 months of seeing inflation not just drop, but stay down there. You know, they need to get this back down to sort of around their target 2% and make sure it's going to be sticky around there and, you know, not suddenly peak again, because otherwise they would have wasted everything that they've just done. We're still seeing a bit in the way of supply chain issues. They have improved, although, you know, COVID, you've got to get that back on your radar. I just made that up, sort of trading and radar, so I just chuck that in there. You know, don't blame me, but I did. Omicron, so it's mutated into many different versions. Now, you know, the question's going to be, will any of them be more lethal as we start to enter winter? China still has lockdowns. There was even a small demonstration in the Shanghai district. And you know, that sort of coincides with the China premiership elections going on as he goes for his third term. Of course, Russia, as I mentioned earlier, with Ukraine, now 8 months. Ukraine gaining that ground. Russia bombing in retaliation for the bridge damage. Both sides probably getting short of weapons now, I would guess. You know, but it is only a guess. energy and food inflation. So they seem to be easing, but it's not being reflected in the data. You know, wages, power, greed. They're the things that I see within the companies at the moment that's impacting and making them keep prices up. You know, maybe they just want to sort of get as much profit in the bank as they can because they can see that that recession is going to sort of appear at some stage and probably not so far in the future. Job losses I expect as well. Okay, so just move on to trading tip of the week. Technical analysis, it's just a short one. So, as you know, when it comes to trading, I teach so many people to learn to trade. And for me, the thing I always say to them is trading should be simple. Simple is best. So also not just in your trading plan, but also in your analysis. So try to limit the number of indicators that you add and also the number of lines you add as well. Otherwise, you know, I've seen some traders' charts, they look like a spider's web. There's so many lines all over them. And you don't want that to happen. Just have the meaningful ones on there. However, also remember that, you know, if you've got a support line and it's broken, then that then turns into a resistance line. Don't just remove it straight away. It can still have some value to you. All right, so moving on to the technical analysis part. Yep, the markets had a crazy week again last week. You know, I can't see anything other than this continuing all the way up to Christmas. Okay, so just a reminder, so pivot point colors, the Fibonacci is there, and there are a couple of each this week. So just remember them. Now, also on the right hand axis, there's black numbers. They are support and resistance levels, just trend lines. So just so it's clarified what those numbers are. Got brown numbers, which are breakout levels. So basically, if it gets through there, expect the market to continue in that direction. I picked out some great ones on Friday in our newsletter for all the stocks. I had breakouts on all of them on the downside, and then they came off an extra probably 300 points after they hit those levels. So they were great opportunities. And the claret numbers are those horizontal levels, just where I either see support or resistance, or I can get 2 or 3 tops or bottoms to line up. Okay, so the first one we're going to look at is the Dow. Now, the Dow held at the pivot point level Friday afternoon, but let's sort of get on to the daily part of it first. So when I'm looking at resistance on the daily, I can above the market at 31,292 and also at 34,98 and support at 28,503. On the 30-minute, we have then got resistance at 29,845 and support at 29,585. This is another breakout level. It's in brown. If it goes through there, then you know it's going to have a bit more of a sell-off in my mind. And support at 29,107. You know, it's just a suggestion to just take a picture on your phone with some of these if they interest you, so you've got them in your mind. Now, Fibonacci levels on the Dow, F1 is 29,698, F2 is 27,481, and F3 is 25,264. So now moving on to the S&P daily, some resistance levels there with some downtrend lines. I've got 39.59, 38.19 and 37.64, and then support at 35.90 and 34.96. Again, they're on there, so just want to keep them, just take a photo of them on your phone as a reminder. Now, Fibonacci levels on the S&P, 3803 is F1, F2 is 3492, and F3 is 3180. You know, they're going to come more and more into play. And then when we look at the 30-minute chart, got a slight downtrend there, a little channel, so resistance at 36.23 and 36.08 with support at 35.85. So this is one of those. So this is the NASDAQ. I've added the Fibonacci's on here and I've made it a weekly chart as well, just to make it easier for you to see where I've taken the levels from. So I've gone all the way back to the COVID sell-off in March of 2020, all the way up to the high of last year, and then put those levels on. Now, as you can see, it's already been through and tried to retest it and then failed again on the 382 level there, the blue one. And you know, sort of the 50 hasn't really had much to play with this time. But on Friday, it was interesting because it did come down and test just about the golden ratio, the 618. And of course, as analysts, we all loved that level. Just remember, you know, if it breaks below, stays below, closes below, continues below, then it's no longer a retracement. In my mind, it's then become a reversal. You know, always remember, this is just me telling you my views. This, you know, doesn't mean I can't be wrong for sure. I wish I wasn't, but you know, none of us are perfect. Okay, so here's the NASDAQ Daily. Now, when we look at the NASDAQ Daily, then I've got some resistance and support levels on there, just a couple of basic ones. So resistance is 11,839, and a much closer one at 11,239, with support at 10,473. On the 30-minute, we've got resistance at 11,185 and at 10,853, support at 10,701. And a reminder of those Fibonacci levels, just in case you want to make a note of them for the NASDAQ, if you're brave enough to trade the NASDAQ, that is. F1 is 12,909, F2 11,709, and F3 is 10,510. And finally, for the stocks, the Russell 2000, you know, these are the smaller mid-cap stocks. They're much more sensitive to what's going on within the economy, you know, especially from consumers. So on the daily, we've got resistance at 1782 and support at 1642. On the 30-minute, I've got resistance at 1760, and then we've just got this small little triangle there, and on that we've got 1700 and support at 1689, and then lower down at 1661. Moving on to a couple of currencies. So cable, pound against the dollar. You know, again, we're seeing that roller coaster because of the political situation. The economic situation isn't great, although I must admit, when I go out, you know, to the shops, I'm based in the UK, people are still shopping, people are still buying for sure. I mean, the weekend, Friday, Saturday, I mean, the shops were packed actually. So, you know, whether that's going to reflect in the economy. Right, so on the daily, I've got resistance at 115.10 and 113.84, with support at $1 0081. You know, again, it depends what goes on with the political situation in the UK, the economic situation in the UK, and of course we've still got the dollar strength. You know, the dollar is king for sure. Now, if we look at the 30 minutes, I've got resistance at 112.86 and I've got support at 111.76. You know, you just got to be a bit careful about buying any of these markets at the moment. You know, I'm not saying don't buy them. It's got to be your decision, but I'm just saying be cautious and make sure you're disciplined with your stop losses. Okay, so moving on to the euro against the dollar. On the daily, I've got resistance at $1.0021 and also at 0.9868. Support is 0.9500. The euro 30 minute, I've got resistance at 0.9846 and support at 0.9765. Of course, we've got to have a little look at crypto. I mean, you know, Bitcoin's probably been more stable than most of the other asset classes recently, which is quite interesting, really. Okay, so when we look, I'm just keeping this breakout level on there. It could hopefully get there one day. That 27,400. You know, obviously it's nowhere near there, but the time I stop mentioning it is probably the time it's going to do it, if it's going to do it. So I'm just keeping it on there every week. And then below that, we've got 24,673. And below that, we've got 20,520. Support at 17,736. Now, 30 minute, I've got resistance level above at 19,804. And then I've got a much tighter one. You know, this is destined for a breakout pretty much straight away, of 19,187 with support at 19,101. So, as you know, I like to include the Bitcoin versus NASDAQ on a daily. And, you know, as I just mentioned, you know, that it seems to me that the crypto's been that little bit more stable than most of the other asset classes recently. Yeah, it hasn't stopped it moving for sure. But, you know, we're used to that being the crazy one, whereas at the moment, all the markets are the crazy one. But as you can see, probably that sort of correlation, that loose correlation, wasn't quite so tight by the end of last week. So now we're just going to move on to a couple of commodities just to finish off with. So we've got the gold daily here. I've got resistance at 1712 and also at 1677 with support at 1586. And then moving on to the 30-minute chart, I've got resistance at 1677. Again, that sort of coincides with the one on the daily. And then below that, I've got another one at 1651 and support at 1645. So again, tight range there. You know, you would expect it's got to break out of that one way or the other. Last but not least is oil, WTI. I've got resistance at 93.04, and then I've got support at 84.89 and 78.47. On the 30-minute, I've got resistance at 87.01 and 85.87 and support at 85.16. Yeah, another thing to bear in mind is when I give you these levels and I'm giving you all of this information, all this analysis, this is all based off of the futures. Please remember that these are futures that I trade. So all of these indicators are So you'd need to work out what the difference is between if you're trading CFD's prices to the futures to work out what your levels should be. But, you know, hopefully at least the charts will give you something visual to work out, you know, where you can see trends, where you can see support, where you can see resistance, regardless of you know, what or how. As usual, just going to finish up with a little bit about us as a company, what we do. So we provide, obviously, this to help prepare you for the week ahead, and hopefully it does that. Love to get some feedback from you on what you think. If there's anything that we should change, you know, bad criticism, anything, you know, positive, don't mind, you know, good, bad. It always helps us to improve, and that's obviously the key of what I'm trying to do. You probably tell me not to waffle on so much, but that's just my style. Anyway, daily newsletter. These go direct to your inbox each day, each morning, Monday to Friday, and they include global news, my views, and also fresh daily chart levels and fresh daily pivot points. And just sign up for that. You know, we'll give you a free trial, no problem. Then we've got one-day workshops to help fill in any gaps you've got with any trading skills that you already possess, knowledge, etc. And of course, you know, reach out if you want anything specific. I'm happy to try and cater for your needs. 1 week courses, we do a really sort of intensive 1 week, which takes you from 0 to hero. It gets you sort of confident on the trading system, making those decisions, assessing risk, analysing markets, etc., etc. And then if you really seriously want to turn this into a career, we've got our full real flagship masterclass that we do. It's 4 weeks of guided learning, but you don't have to take them all at once. You can split them up and fit them in around the rest of your life. And of course, if you do that masterclass and then you can pass the exams and a challenge that I set, we'll happily give you a job. We're always looking for new traders. Okay, so then moving on from that, trader mentoring. So you may have some skills and you may want to get to that next level. I can help you do that, and I can help you do it not once, but time and time again. Consulting, we consult to lots of companies. We help them to manage their risk exposure to foreign exchange, to commodity prices, and you've seen how volatile they are. You know, whatever we create is always flexible to give them the best results. And also we're a provider of trader educational content to exchanges, to brokers. And of course now we've got this added offer with this partnership that we've created where we've got over 85 other educators, anything to do with finance and beyond finance. We've got hundreds of new courses that we offer, over 20 awarding bodies for accreditations. And of course, we provide these to over 10,000 customers per year. They could be anything from students, you know, entry-level guys going into finance, maybe going into compliance, governance, risk or whatever, all the way through to sort of, you know, professionals and executives. And of course, you know, we constantly have these updated because of the awarding bodies, make sure that we're always current with what we are providing to the people that come on our courses. And the courses we can do live, we can do self-paced, and we can do a hybrid. Okay, so finally, contact details, info@symaxfintech.com, and my email is there, chris.tubby@symax-int.com if you've got any trading questions or anything that you'd like to direct it just straight to me, no problem. You know, I love conversing and communicating with people that are interested in trading. You know, it's been my career for 50 years, not, you know, 40 odd years trading, but in the markets for 50 years. So it's, you know, it's just been my passion forever, and it will just continue. You know, I love getting out of bed every morning just to do all of this. Okay, so right, I'm not going to bore you anymore. So I hope you've enjoyed this. Have a great week, and hope to see you again next Monday. Take care for now. Best of luck. Bye.